The monthly media briefing was addressed by Deputy Bank of Uganda Governor Dr. Louis Kasekende.
The primary objective of monetary policy remains holding the medium-term annual inflation to around 5% target without compromising the further recovery of the economy. The Bank of Uganda will maintain the central bank rate.
Movement in exchange rates in the market has stabilized, though at a modest rate, largely due to increased exports. The economy is projected to stabilize if the capacity to generate industrial growth is boosted.
We have actually seen increased exports, especially in January, but we have also seen increased inflows coming especially from the offshores.
On the other hand, continued weakness in the growing of the shilling-denominated loans to the private sector remained stagnant, with a slight decline of 0.6% as opposed to 1.1% by forex-denominated loans. This is attributed to high lending rates to the agricultural sector, based primarily on peasant cultivation with fluctuating international value.
And the recent buoyancy of foreign exchange inflows, which have strengthened the exchange rate, all militate against inflationary pressures.
Meanwhile, the central bank says the withdrawal of the 1987 series banknotes is progressing well. The notes ceased to be legal tender on 31st March with limited exchange through commercial banks by 31st May.
People have an opportunity of using their commercial banks between end March and end May. And beyond May, between May and the end of this calendar year, they can use Bank of Uganda to still exchange their old banknotes that we have recalled.
In its monetary policy statement for March, the central bank forecasts constant annual core inflation over the next 12 to 18 months, though the upward risks such as international fuel prices may create jerks. There is need for increased financial growth, principally contributed by the service sector. Sharon Kembabazi, NBS Television, Business.